The capital flowing into the digital asset ecosystem because of stablecoins is massive. I believe the industry is heading toward a $15 to $20 trillion valuation. As Bitcoin nears new all-time highs and altcoins begin to show momentum, all eyes are on Donald Trump, who is expected to sign the genius bill, the Stablecoin Act. Though he hasn't signed it yet, this bill could transform the crypto market, currently at around a $3.40 to $3.44 trillion market cap, by opening the floodgates for massive inflows and pushing the space toward $15 to $20 trillion in value. The bill has already reached his desk with full bipartisan congressional support. That's significant. We haven't seen bipartisan legislation pass through Senate banking since 2018. This is major news for Bitcoin and Ethereum. Aptos is also making waves. Watch today's full video for more. Meanwhile, both the Nasdaq and S&P 500 have hit all-time highs. For crypto to thrive, traditional markets must also be strong, and that's what we're seeing. Nasdaq is surging. The S&P 500 is climbing, and veteran investor Tom Lee believes this is only the beginning. He explains that market fundamentals and clarity are now stronger than they were back in February during previous highs. He highlights three powerful levers that could push the market further. First, the Fed didn't inject liquidity during the levers that could push the levers that could push the market further. First, the Fed didn't inject liquidity during the tough liquidity during the April lows, but if incoming data supports a dovish stance, that could mean 12 to 24 months of loose policy and liquidity, which hasn't even started yet. Second, Lee challenges the claim that valuation multiples are overstretched. In fact, he argues they should expand, as companies have already survived 5 major stress tests: COVID, supply chain whiplash, inflation, aggressive Fed rate hikes, and now another potential crisis. If we avoid 5 more shocks, then P/E ratios will rise in the next 2 years. Third, the restructuring of global trade flows via tariffs could actually lead to earnings surprises if handled well. These 3 levers signal that the market, targeting 6,200, is beginning to acknowledge stronger positioning, even as $7 trillion in cash sits on the sidelines. According to Lee, institutional clients are still hesitant, making this the most hated V-shaped rally in years. This means there's still room for growth, and smart money is starting to rotate into quality altcoins. One standout development is the launch of the first Solana Staking ETF, which saw $12 million in inflows on its first trading day. The ETF allows U.S. investors to gain exposure to spot Solana and staking rewards, a first of its kind in the country. It launched on the CBOEBZX exchange, recording $33 million in trading volume. With this product, you don't just buy Solana. You also earn staking yields. This milestone makes it the first approved crypto staking ETF in America. Peter Jung of Presto Research says that Solana's strong demand can be gauged by looking at global ETPs. Outside the U.S., Solana-based ETPs have over $1 billion in assets under management, signaling strong global interest. This trend supports the launch and demand for a U.S.-based Solana ETF. Alongside Solana, we're seeing increasing interest in Aptos and Dogecoin ETFs. Bitwise recently filed amended S1 South for both spot Dogecoin and Aptos ETFs, a positive signal, indicating SEC interaction and approval pathways. An Aptos ETF seems highly likely, especially with major developments around Aptos. CEO Avery Ching now sits on the CFTC Digital Asset Subcommittee, the body shaping U.S. crypto policy. Aptos is positioning itself well. One major milestone is the approval of an upgrade proposal for Aptos v3 on the mainnet. This upgrade signals confidence in Aptos as a serious DeFi contender. With blue-chip protocols expanding to the chain, Aptos Labs is also making waves with a major product launch. In partnership with Jump Crypto, they've announced a Web3 cloud storage platform named Shelby. Designed to compete with AWS and Google Cloud, Shelby empowers users by offering decentralized, distributed cloud storage tailored for content streaming, AI workloads, and real-time applications. Built on a dedicated fiber network, Shelby promises speeds comparable to Web2 systems while offering Web3 openness. Unlike traditional platforms that simply store data, Shelby serves, enabling faster access, monetization, and flexibility for developers. It's the first decentralized hot storage layer designed for high-performance use cases and is chain-agnostic, meaning it's compatible with Ethereum, Solana, and others. It's particularly geared for streaming video, real-time applications, and artificial intelligence. Shelby arrives at a time when global data demand is skyrocketing. Its design prioritizes monetization and cross-chain support, which are both crucial for widespread adoption and developer integration. While there's still more to cover, let's pivot back to the broader crypto market. Bitcoin continues to lead the cycle's bull run, as it historically does. However, all signs now point to Ethereum beginning to drive the next altcoin season. Ethereum's fundamentals are strengthening. Since the merge, Ethereum's annual inflation rate has dropped to just 0.105%, compared to 1.347% for Bitcoin. That makes Ethereum more scarce than Bitcoin in terms of new supply. And Ethereum becomes even scarcer as its network activity increases, with more ETH burned per transaction. Large, publicly traded companies are starting to take notice. For instance, SharpLink will ring the Nasdaq closing bell on July 7th, celebrating its role as the first major public firm to adopt Ethereum as its primary treasury asset. ETH isn't just a part of their strategy, it is the strategy. Meanwhile, Tom Lee has become chairman of a company committing up to $250 million to Ethereum. He explains why this is significant. He sees ETH potentially following Bitcoin's model, referencing MicroStrategy, a company that accumulated over 600,000 BTC, becoming a central pillar of Bitcoin's institutional adoption. Lee believes that MicroStrategy now holds what's essentially a sovereign put, meaning, if the U.S. ever wants to adopt Bitcoin reserves, they could buy MicroStrategy instead of sourcing Bitcoin from the open market. As a result, MicroStrategy should never trade at mere net asset value because of its strategic importance. Furthermore, by holding such a large Bitcoin reserve, MicroStrategy gains unique advantages in capital markets. It can raise capital at much cheaper rates, compared to someone who simply holds Bitcoin as an individual or in a private entity. This strategy has worked well for them. And now, we're seeing similar approaches start to apply to Ethereum. This suggests a shift, not just in investor sentiment, but in institutional positioning around Ethereum as a long-term asset. This is why Ethereum isn't just part of the strategy anymore. For some major players, Ethereum is the strategy. And that's a major signal to watch if you're an ETH holder or someone considering entering the space.